All right, everyone. Well, what I'm going to do now is I'm going to briefly walk you through the spreadsheet that we did in class last night with regard to this concept called ratios and multipliers with a little bit of cash flow forecasting into some future periods of hold. All right, so let's get started. What we have here, if you'll recall, let me drop this down a little bit, is this is the spreadsheet that we did last night with regard to ratios and multipliers. And what we have here is basically just a plain vanilla scenario. We're looking at purchasing a property for $4 million, and we're given here a financing program. I've not asked you to underwrite the financing possibilities at class last night. We're just given some loan-to-value ratio. So we're told that the loan-to-value will be 70%, meaning that 70% of this purchase price then is going to equal $2.8 million for the loan amount. Right? Now, when we take the $4 million and we subtract the $2.8 million for loan, we know then that the down payment must be $1.2 million. That's the purchase price less the loan amount. That's going to be 1.2. In this scenario, I also said that there's going to be some other acquisition closing costs here. Call it 50 grand. The loan point, who knows, whatever the Mickey Mouse is, the escrow, the title, the recording. Maybe there's likely an appraisal. Whatever the closing costs are, throw this into the hopper because we need to calculate an equity amount to put into the deal. This is the initial equity, which includes the down payment, any closing costs to close the deal, plus perhaps any reserves initially that the lender may require. And we call this T sub 0, time 0. That is our cash in at the very beginning of the deal. We've calculated here at 1.25 million. I've also mentioned, for the sake of argument, that the interest rate is going to be 6%. Therefore, we can calculate a payment. You should know how to do that pretty easily by now. And then the future value of the loan at the end of 1 year is going to be $2.7 million. So we started out with a $2.8 million loan. We paid it down for a year. And at the end of that year, the balance will be 2.765 and change. We need this number in one of our calculations that's going to follow. So the beginning amount of the loan and the ending balance of the loan during that first year, the difference between the aggregate of the payments and the future value of the loan will be the interest that we will have paid during the first year. Okay? This principal pay down is going to be the difference between our original loan amount and our balance of that loan at the end of year one. That's called principal pay down. That's one of the inputs that we need a little bit later, right? And then the difference here between the amount of the monthly payment times 12, which is our annual debt service, and the principal pay down, that difference is the interest for the first year. So as you can see here, the majority of our payments during the initial years of a transaction are pretty much just about all interest. Okay, so that's the financing scenario that was proposed, or rather that we secured. We didn't underwrite this, it was just a given. Then what did we do? Well, I gave you kind of a plain vanilla scenario of there's this particular property that has a gross potential rent of $400,000. We essentially reconstruct the operating statement like we've already learned. But then what have I got here? The hold here, we've anticipated to be 5 years. All right? Then it begs the question, Mark, why are you taking then these numbers out to 6 years? Well, the reason for that is because when we hold for 5 years, when we sell it, we're going to capitalize year 6's net operating income by this terminal cap rate that was given in order to determine the likely or potential sales price at the end of the deal. So again, If the hold period is 5 years, we need 6 years worth of operating data. If the hold period is for 10 years, we need to take our columns out to year 11. If we're going to hold this thing for 100,000 years, we need 100,001 columns of data. Okay? So whatever our hold period is, we will capitalize the next year's NOI in order to get to our terminal value when we sell here at the end of year 5. Okay? So we've done all the reconstructed operating statement. We've already done that. Then what do we know? Well, we know that the net operating income is all of this. We know then that the annual debt service, which is our monthly payment times 12, we just plug this here into all 5 of these operating years. And then the net operating income less the annual debt service equals our before tax cash flow. All of these formulae are on page 241 of your class text. This is Unit 12, Traditional Measures of Investment Worth. You can frame it as, what did I have here? Ratios and multipliers with a little bit of forecasting because we're taking these numbers out into the future. How do we derive these numbers? Well, we're going to assign some type of an inflator or maybe even a deflator over the hold period. And that's really going to be a part of your market study. Or in some instances, it might just be a gut instinct that you might have, kind of where the trend is for rents and expenses. Okay, I've given you here a terminal cap rate of a 6.25. For the sake of argument, we'll just accept that right now. This is called K sub T. That's the terminal cap rate, K sub T. Therefore, then, I can anticipate the future value of this property at the end of year 5 as being 6.7 million and change. That terminal value is called V sub T, terminal value. Now, we get into the multipliers and the ratios now. The multipliers are going to be the gross rent multiplier, the effective gross income multiplier, and the net operating income multiplier. Now, I recorded a brief hand calculation video that's also posted in the videos tab at Canvas, as well as the week 5 module for the course, right? So I go through the formulae on how these numbers and these ratios and multipliers were derived. Okay, so gross rent multiplier, EGI multiplier, NOI multiplier, basically just looks at the gross rent, the EGI, and the NOI. Now, what do these numbers really mean? Not so much unless you're just looking to get a gauge or a little bit of a handle on how this building may perform presently and may be likely for the next year or so. Okay, the operating ratio. This means what percent of the effective gross income is being chewed up by expenses. So this 15.81 is pretty low. That's a pretty low operating ratio. Recall at last night's class, we mentioned that these operating ratio numbers, this operating ratio, typically ranges anywhere from maybe 28 on the low side, and then you would kind of go up from there. The higher the operating ratio, typically, the more inefficiently the building is being operated. Or number 2, maybe the property is just old and needs some upgrades. So it's being a lot of the EGI is being chewed up in OpEx. Okay, the break-even ratio. In this instance, we calculated to a 68.55. That's an input because what we want to know is how much or to what extent may the effective gross income decline or the expenses increase before the building cannot service its debt. That means that you as the investor or your investment group is going to now have to start putting money into this building, into this deal, in order to support the payments so the lender doesn't foreclose on you and take it away from you, right? So in this instance, then 1 minus this break-even ratio equates to 31.45%. That means that the effective gross income can decline or the expenses can increase by about 30% or so before the building cannot service its debt and you have to start feeding the building. The debt coverage ratio in this instance is 1.6. That means that 60% of this net operating income is not being eaten up by the mortgage, by the debt service. Okay, so 60% is being held in reserves. That's pretty good. And I think the reason for that is because our operating ratio is only 16%. If this operating ratio were higher, this debt coverage ratio would be lower. Okay, the capitalization rate, you should be able to calculate that blindfolded with one hand tied behind your back. This is often abbreviated, as you already know, by a capital R or a small k. So in this regard, we've got an 8.04 cap rate. That's pretty darn good. If you can find a building with an 8 cap, call me and let's see what we can do. The equity buildup. This means how much are you paying down the principal every year. So this first year, we're paying down the principal by $34,000 and change. This spreadsheet will also be posted at the week 5 module so that you can kind of reference these cells and then determine how these numbers were derived. If you review page 241 of your textbook, you can clearly see how these numbers were derived. All right, the equity dividend rate, this is basically the cash on cash return. This is a 9.61%. This is basically for my down payment and for the closing costs that I'm depositing in the deal to close it. For that, what am I getting as a return for my first year? And in this instance, we're getting a 9.61% return. So this could be, on the face of it, a pretty attractive investment, at least from a cash flow standpoint, for an investor for their first year. If they're unparking money from Bank of America or City National Bank in some ridiculous low-interest passbook savings account, well, they're going to make clearly about 10 times more than they'd be making in the bank. Right? The broker's rate of return, very kind of an interesting metric. I said that the broker's rate of return can be called blow us, smoke us, because the broker is trying to inflate these return numbers in order to make the deal look better on the face of it than it might be. So in this regard, the broker's rate of return is a 12.36, which includes this equity buildup. Some brokers will even also include the anticipated value growth year over year. The problem with value growth and throwing it into a return is that value growth is unrealized. The value is still in the property. You haven't cashed that out yet. So how can you reflect it as a realized return? That's the underlying problem with the broker's rate of return, also called BS for blow us, smoke us. The equity payback period, this is the number of years that it will take the investor to get their equity back, their initial down payment, plus the loan fee, if any, plus all of the closing costs, plus the reserve. Whatever this equity amount was at the beginning of the deal, you divide that by the by the before tax cash flow, and that's going to get you the number of years that it's going to take to return that initial equity to the investor. So 10.4 years in this regard. Okay, so that pretty much in a nutshell explains the ratios and multipliers that we talked about last night in class. Remember, we always want to reconstruct an operating statement and then determine the financing scenario, and then run these numbers through these ratios and multipliers. This is fairly straightforward stuff, and especially when you know what these numbers mean, it becomes much easier then to interpret the relative investment merit of this property versus another one. So I'm hopeful that's helpful, and we'll see you soon.